Be Wealthy and Smart, episode 844.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about interest rates are on the rise because we've been accustomed to these very low interest rates for a long time. This has been 3 decades that interest rates have basically been on the decline, and it's actually been longer than that. It's been back to 1982, I believe, was the peak in interest rates. And recently, we were even hearing things like the UK was talking about in the next 6 months taking interest rates negative. And that's something we thought could possibly happen here in the United States, and it still might. But right now, interest rates are trending up a little bit, and that's in response to some signs that inflation might be on the horizon again. We're seeing higher prices in lumber for building new houses. We're seeing higher prices in meats like chicken and beef. And we're seeing higher prices in energy like gasoline. So the higher prices for commodities, agriculture, all kinds of metals and minerals is really wreaking havoc right now because it's causing pressure on the bond market and raising bond yields. Mainly, it's just a cycle that I've been picking up that we have a 6 or 7 week bumpy ride here into mid-April that we're going to see some pullbacks in technology stocks. We're going to see some pullbacks in the large caps. We're going to see a little bit more volatility than we have, and we may see a rotation back and forth between paper assets and real assets before we really turn the corner into real assets becoming worth a lot more. I've talked about how commodities are going to be a hot area this year. Also talked about how precious metals are part of that formula, and that this is a longer term cycle that does happen every 30 to 40 years, where we've literally bottomed out and gone as low as we can go without going negative yet with interest rates, and we still might. But we turn the corner, the cycle starts to go the other way. It's a pendulum that swings. I talked about it in the Wealth Era's book. And these are normal and natural cycles. Investors are looking for what's undervalued right now, what's out of favor. And the smart investors are snapping up the things that haven't been in favor for quite a long time. And the favorites that have gotten really extended and overvalued and have some crazy valuations out there, they're the ones that may not do as well going forward, as I've explained on previous podcasts with the technology boom in 2000, where some of those technology stocks weren't the real winners going forward. There was a rotation at that time as well. We have a lot of new technology coming in, a lot of new things that will be up and coming, and these things will capture the imagination of investors. And as people learn these new companies and learn about their technologies, they'll start to get excited about them and want to invest in those areas as well. So there's just going to be a lot more competition for investor dollars going forward. And I think people will be not as likely to invest in things that might not be giving them any return in terms of profit and have profits years away, to things like commodities that are tangible, that are limited in supply, that are throwing off lots of cash as commodity prices rise, and that metal in the ground or that rare earth mineral in the ground becomes much more valuable, and the company becomes much more value and much more profitable as the commodities prices rise. So we're seeing this pendulum shift into real assets, and I think that's going to continue. But today I wanted to share with you an article about interest rates because I thought it gave a lot of good information about what's going on and what some economists have to say about it. So this article comes to us from CNBC. It was written by Patty Dahm, and she made 3 key points. Her first key point is interest rates are rising because of expectations for better economic growth, and they should continue to move up, but moderately. Her second key point, inflation is a fear in the market, but strategists do not yet see it as a main catalyst for interest rates. And her third key point is the 10-year Treasury yield, which impacts mortgages and other loans, rose to 1.33% early Wednesday morning and could go as high as 1.5% in the near term. Now, before I start with the article, I just do want to make the point that we did see interest rates bottom. We do have the low of interest rates behind us now, and interest rates have gone higher. So if you are thinking of refinancing or if you haven't refinanced your mortgage yet, we are seeing that trend higher. Doesn't mean we couldn't see a pullback and even a time of negative interest rates, because I do have that on my radar, and I think that will happen here. But the question is when? That's the tough one. So it doesn't mean that the bottom is necessarily in, but we have seen a temporary low and we've moved a little higher in interest rates. So here's the article. It says, interest rates are expected to continue their upward march, but for now, they're not expected to get high enough to harpoon the stock market. Treasury yields have been rising quickly in the last week, and the benchmark 10-year yield has been on a tear, reaching 1.33% in the early morning hours Wednesday before retreating below 1.3%. And they're talking about this past Wednesday, not today. Yields move opposite price, and the 10-year has risen from about 1.15% just a week ago to levels that are close to where they were when the pandemic started hitting the economy last February. The 10-year is key to the economy since it impacts mortgages and other consumer and business loans. Bond strategists say the move in yields has opened the door for a higher move, and a next logical target for the 10-year is 1.5%. The yield is unlikely to go much higher in the near term unless inflation picks up or there is a signal from the Fed that it is ready to tighten policy, which is highly improbable. And I just want to pause for a moment and say yesterday we had the Fed hearings and they made it very clear they are not considering tightening at all. So indeed, it is improbable that they would tighten. The article goes on to say, I think it's reflective of economic conditions, which is why other financial assets like equities aren't taking it too badly, said Jim Caron, head of global macro strategy at Morgan Stanley Investment Management. The thing is, you ain't seen nothing yet, he said. That's with a $600 stimulus check. What about with a $1,400 stimulus check in hand? The Treasury market has been pricing in a more aggressive fiscal stimulus program from the Biden administration than many analysts had initially expected. The proposed $1.9 trillion package winding its way through Congress may not be reduced by much. The package includes a $1,400 payment to individuals on top of the $600 they received in early January. Aside from the jobs report, the streak of recent data has shown improvement. January retail sales reported Wednesday rose 5.3% versus forecasts of 1.2% and following a decline in December. The producer price index also rose sharply, up 1.3%, the most since 2009 in January as the cost of goods and services jumped. That suggests inflation is beginning to rise for manufacturers and can be a forewarning for higher consumer prices. JP Morgan economists estimate the rise in the producer price index translates to higher forecast of a 1.7% increase in year-over-year personal consumption expenditures, the Fed's preferred inflation measure. The so-called PCE measures the change in the cost of goods and services purchased by consumers. If this forecast for core PCE inflation is realized, it would be the firmest monthly increase since January 2007, while keeping the year-ago core PCE rate below the Federal Open Market Committee's 2% inflation target, the JP Morgan economists wrote. Even with the better data, the 10-year yield on Wednesday traded at about 1.29% after the early morning move to highs. Strategists said buyers were drawn in at around 1.3% and the 10-year move may now slow or consolidate before another step up. The strong data did cause economists to raise their views on growth. Goldman Sachs economists upped their tracking estimate for first quarter gross domestic product growth to 6% from 5%, and Morgan Stanley economists raised their tracking forecast to 7.5%. Stimulus checks are coming, jobs are coming back. We think this is all going to happen as COVID numbers start to fall, said Karen of Morgan Stanley. We're still going to get that $1,400 check, he said. Plus, there's pent-up demand. The party's just getting started. The jump start to the economy has some investors worried that another big stimulus package will be igniting inflation and leave the U.S. struggling under a mountain of debt. But Karen does not think the market is responding to that, and the stimulus is a jolt needed to fill the output gap created when the economy fell off a cliff last spring. He also does not expect inflation to be a problem. The market, however, is beginning to price in more inflation. The 5-year break-even, a market-based inflation instrument, was reflecting the view Wednesday that consumer inflation will average 2.37% over the next 5 years. You can take your pick whether it's the yield going up with the stimulus or the economy, and now the stimulus is actually impacting the economy. We've got stimulus already done, which is making people spend, and stimulus to come, which will spur more spending, said Michael Schumacher, head of rate strategy at Wells Fargo Securities. Inflation has been a talking point for the last few weeks. Economists expect inflation to perk up in the spring, along with higher prices from pent-up demand. However, they don't expect the increase to be sharp enough for the Fed to engage on policy. Ed Hyman, chairman of Evercore ISI, said on Wednesday that 2022 growth looks stronger and above trend due to stimulus. He said he was now expecting 3% growth in 2022 after 7.8% growth in 2021. However, Hyman's view of inflation is still fairly tame. The core PCE deflator is likely to increase 2.25% year over year in both 2021 and 2022, elevated but not significantly, he wrote. Hyman expects the 10-year yield to reach 2% this year and 2.5% next year. Probably the most important point here is that we're in the early stages of a new expansion that's likely to last at least through 2025, he wrote in a note. Strategists say rates should not rise too much with the Fed's low rate policy and its bond buying program. The Fed Wednesday reaffirmed its concerns about the economy and its plans to stay on hold for the foreseeable future in the minutes from its last meeting. The December spending legislation assured the economy of more fiscal support, as did the incoming Biden administration's release of its economic recovery proposals, which brightened the broader discussion of the outlook in the minutes, but Chairman Jerome Powell's press conference made it clear the economy is not out of the woods yet, said Bob Miller, head of America's fundamental fixed income at BlackRock. And subsequent comments from other Federal Open Market Committee meeting participants reflect that now unified communications, essentially that it's too soon to talk about tapering the asset purchases, Miller said. End of article. All right, so that's just a lot of economists saying that they think there is positive growth ahead, not too much inflation, and the Fed is still in easing mode. So while inflation has picked up a little bit, no one is seeing it as runaway inflation or any possibility of that in the cards just yet. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available so you never miss one of them. And if you're looking for a good financial book, check out You're Already a Wealth Heiress, Now Think and Act Like One, 6 Practical Steps to Make It a Reality Now. It was named to the all-time best wealth book list by Book Authority, and men love it too. There's lots of great ideas and stories, a wealth checklist, your millionaire action plan, things that you can really use practically in your everyday life as well as with your investment strategies. It's available on Amazon, Amazon.uk, and all fine bookstores. And don't forget, my entire podcast library can be found over at lindapjones.com/podcasts. Only a small portion of my podcasts are actually on Apple Podcasts. The whole library, though, is over on my website. So check that out at lindapjones.com. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.